right, thank you very much. I would like to thank the 3H group for inviting me here. Albert said earlier that I was 22 years old, and to be honest, I have a difficult time keeping track of my own age, but I am actually 24 years old. But people do say that I look younger than I actually am, so that's okay. I've been invited here to talk about the European debt crisis. And so I'm going to give a brief historic overview of what happened, why this occurred. Also, I'm going to talk about ways of solving it, and also, most importantly, what we can learn from it in order to make sure that it doesn't happen again. I would like to start out by pointing out that all organizations have as their goal to grow, to expand, to recruit more members, to earn more money, to spend more money. Because no organization wants to reduce in size, because that would be pointless of having an organization. And very, very few organizations want to stay the same size forever. And this, of course, is true for governments as well. They also want to expand, and they want to earn more money, they want to increase their population, and they especially want to spend more money. And the reason why they want to spend more money is because that makes the voters happy. So they will then vote for these politicians. But too much spending, of course, leads to budget deficits. And this was certainly the case in Europe even before the euro was introduced. As you can see, here are some examples of public debt levels in Europe. In 1991, the euro, it should be pointed out, was introduced in 1999. So this was 8 years, I guess, before that. So as you can see, they were very high already. As these European countries were preparing to introduce the euro, they had to fulfill what was called the Maastricht Treaty, which states that no member country in the Eurozone can have a public debt exceeding 60% of GDP. So these countries had to basically reduce their public debt levels. Sometimes they had to, in some cases, they had to halve these debt levels in order to conform with the Maastricht Treaty. When governments take on public debt, they usually do it by issuing bonds, which are basically a kind of loan. And before the euro was introduced, many of these countries had very high interest rates on their bonds, because investors simply thought that they might not get their money back on time, and also these countries had quite high inflationary levels prior to the euro. But as they were reducing their public debt levels in order to conform with the Maastricht Treaty, their bond rates actually went down, as you can see on this chart. So here are the so-called PIGS countries, pretty derogatory term for some of the most problematic countries in the euro today. So you see Spain, Italy, Ireland, Portugal, and Greece. And these are the 3-month government bond rates, and as you can see, they all went down towards the same level as Germany, which was regarded as one of the most financially stable countries in Europe at that time. So they dropped down to the same level roughly as Germany. And the simple reason for this is that investors thought that if these countries introduced the euro, they would suddenly have a higher ability to repay their bonds. Simply because if these individual governments couldn't repay the bonds, then other euro governments would help them out, because that would save the whole euro currency union. As these bond rates went down, of course, governments started borrowing again because it became very cheap to borrow. And like I said earlier, governments want to spend money in order to make their voters happy. So the irony here is that once they actually introduced the euro, the lending, or the borrowing rather, for governments went up, whereas before they introduced the euro, it was going down. And as these governments started exceeding the Maastricht Treaty, there were calls for penalties, punishing these governments for not conforming to this treaty. But the problem is that punishing the governments in this way was a sort of political dilemma, because if they would have forced these governments to pay fees to the EU, then they would risk upsetting both the politicians and the voters in these countries. So they simply couldn't penalize them for taking on too much debt. So what they did, they started diluting the Maastricht Treaty, and so they added all these exceptions to this treaty, which essentially made it so that none of these countries exceeded their public debt level according to the Maastricht Treaty, because there were so many exemptions. And of course, as a result of this, the public debt just continued growing. And at the same time, as Seljin pointed out, there was a boom in the making, because both the Federal Reserve in the US and the European Central Bank were lowering interest rates, and they were lending out money and credit rather very, very cheaply. So you had this boom, this start of this boom cycle. And this, of course, encouraged further spending by these governments, because they reaped a lot of rewards from it. They could earn a lot of revenue from the taxes because of this high economic growth. So they had this increased spending and this increased public debt at the same time. And once the financial crisis hit, the governments were suddenly hit with these very large budget deficits, because tax revenues dried up, so they had less income from taxes, and they also, as unemployment increased, they also had to pay unemployment benefits, for example, and this, of course, also resulted in a lot of bank failures across Europe, just as it did in the US. Since the governments didn't want to have a short-term bank crisis, they started bailing out all these banks. And in 2009, the total bailouts had reached 5 trillion euros, which is, of course, a staggering amount. And this included all the countries in the Eurozone. And when they bailed out all these banks, of course, public debt grew even higher. So they had further problems with that. And some people like to blame this on the banks, because they believe that since the banks were getting involved in all this predatory lending, as it's been called, they risked the financial stability of the whole economy, which is true in a way. But ultimately, it was the decision of governments to bail out these banks. So, of course, these banks lobbied for bailouts, they wanted bailouts, but it was a political decision to actually give them these bailouts. I would argue, just as Seljin, that bank failures are a necessary evil, so to speak, because in order to get back on your feet after a deep recession, or after a financial crisis rather, you have to let the banks, the insolvent banks, the bad banks who have been behaving badly, you have to let them fail in order to get the economy back on track. And you can see this in the case of Iceland, which we're going to take a quick look at. Because the story of Iceland is they experienced an even worse crash than most Euro countries. As you can see, their bank assets equaled 10 times GDP in 2008, because the Icelandic banks were lending out so much money that they didn't have. And so they had this massive crash once the financial crisis hit. And of course, Iceland is a very small country. I think it has 350,000 people. So the government, of course, is very small. It doesn't have a lot of money. So it simply couldn't bail out these banks. It had to let them fail because there was simply no way of bailing them out. And during the Icelandic crash, 96% of the stock market in Iceland vanished. the currency dropped about 44% against various major international currencies. So they had this massive crash, and they didn't bail out these banks, which is in stark contrast to the rest of Europe. And what happened was that all these malinvestments and all these bad banks were liquidated. And so initially you have this enormous crash, of course, it's enormous recession. But what this allowed the Icelandic economy to do was to clear it, to clear out all the bad investments and the bad banks. And you could move all the employees from the unproductive sectors, such as the financial industry, and into more productive sectors, like producing basic goods and services that people actually needed. And even though they had this acid test for about 2 years, where the economy was very poorly performing, they are now actually returning to growth, and according to the IMF, their economy is supposed to grow at 2.5% for this year. And their budget deficit is decreasing and is expected to be completely gone by 2012. And this, of course, is not the case in Europe, in the Eurozone, where they bailed out the banks, and as a result, their deficits have just grown and grown and grown, and they're not having any growth at all. In fact, their economies are still contracting in some countries. One thing that has been hotly debated during this financial crisis are credit default swaps. And what they are is basically a sort of insurance against default. So if I believe that the Greek government will default on its debt, I can buy credit default swaps against it. So if the Greek government actually defaults, then I'll get a lot of money, which is of course great for me. And what this does is, when a lot of investors buy credit default swaps, it signals to the market that the Greek government is under increasing risk of default, which means that investors become less and less, they don't want to borrow as much money to the Greek government as they did before, because it's considered too risky. So it becomes more and more expensive for the Greek government to borrow money. And some people have sort of likened this to a Greek piñata party, where you have all these investment banks around the world who are sort of beating up the Greek government with these credit default swaps in order to try and sort of get money out of the Greek government, try and make it default. And this, of course, has been considered detrimental to a Greek recovery. Some analysts are believing that this is a sort of financial warfare against Greece. And that will not help the Greek government or economy to recover. But credit default swaps actually fill an important purpose, because the only reason why you can attack a government in this way is because it has mishandled its finances. So if the Greek government hadn't been taking on all this debt and had actually been careful in its spending, then it wouldn't have been possible to buy all these credit default swaps against it. And so if this credit default swap speculation would actually force the Greek government into a default, you have to remember that the Greek government would have defaulted sooner or later anyway, because they would have just continued taking on more and more debt, because it would have been cheap to borrow money, and so they would have collapsed eventually. So the credit default swaps are essentially just they're just cutting this disaster short. They're just making sure that it doesn't go too far. So I think that while credit default swaps are not necessarily completely problem-free, they actually fill an important purpose, because they force austerity, they force government to cut their spendings in difficult times. I don't know what time I have. 5 minutes. I'll skip this. So some of the current solutions that are being enforced around in the Eurozone are the following. One is cutting spending, obviously, which reduces deficits. The second one is increasing economic competitiveness by increasing the education and also removing labor regulations, for example, to make it cheaper to hire people, essentially. Raising taxes, another popular solution. Deregulation and privatizing, in other words, selling off state-run companies in order to raise revenue. And also you have these emergency loans from the European Union and also the IMF, which I think during the first round they guaranteed 110 billion should be euros, and the second round was 750 billion euros. So a lot of money has come from the EU and IMF in the form of loans for failing governments. But all of these solutions require political willpower because they're very unpopular among the public because they lose all these benefits. So these solutions haven't been put in place to the necessary extent. So they haven't actually contributed a lot to our recovery. And you can see this from this chart. The public debt, public deficits, and unemployment rates across the Eurozone in the so-called PIGS countries, the ones that are worst off. So what will happen? I think there's no happy ending to this. I think there are three likely scenarios that can happen to the Euro countries. One is that some countries may abandon the euro and go back to their old currencies, which would allow them to just inflate their money supply and print their way out of debt, basically. So they can just print money and then pay off their debt. A second alternative is to keep the euro and enforce austerity measures. But again, this requires a great deal of political willpower, so it probably won't happen. And it's also a very slow and agonizing recovery because it will take years and years and years of austerity to pay off all these debts. The third alternative is to simply default on the debt, so the governments basically become bankrupt. And you start over and you with a more sort of sound structure. And this would, I think this would be the best alternative because you would probably see a sort of Iceland-like recovery where you would initially have a big crash, but it would also allow growth to pick up again and you would recover. So these are the three things that I think should be done about this crisis. Number one is to exit the euro, because all currency unions create a moral hazard, because as we saw earlier, governments borrow a lot of money because they expect that all the other member countries will just bail them out if something happens. And it also causes discrepancies in both real interest rates and also you can have trade imbalances, which has been a big problem in Southern Europe especially. The second thing is to abolish central banks altogether, so not just revert back to national currencies, and to privatize the monetary system, because this would first of all make it easier to recover, because you would have a clear, the financial markets would clear, and you would also have no lender of last resort, which, as we saw in Selden's speeches, would lead to banks being more careful about who and what they lend to. It also makes government borrowing more difficult, obviously, because they can't resort to their own central bank to get funding. They have to raise it in other ways. And the third thing that should be done is to never ever bail out any banks in the future. Because when governments do this, they go through this extraordinary debt crisis that they simply can't get out of. It also prolongs the recovery because you're keeping all these insolvent and bad banks going. And this too creates a moral hazard because it teaches the banks that you can take extreme risks, you can earn a lot of money, and you can just turn over all the losses to the government and the taxpayers. So you never have to worry about any risks, which of course is extremely bad. Yeah, the road ahead, like I said, I think I don't think the government will take these measures that I just suggested. I think they will either default or exit the euro and print their way out of debt, or do austerity programs for several years. And it will be different for different countries. Greece and Germany, for example, may abandon the euro. They're quite likely to do so. Others may default. Let's skip this part. So that was all for me. Thank you very much for listening.